Good afternoon, everyone. It is January 15th of 2024. Hope that everyone had a great weekend, is having a great start to the new year. We have a few things that we want to go over this week. We certainly had some monumental events take place across the world this week, the least of which was U.S. strikes against Yemenis rebels known as the Houthis. What does that mean for the energy markets? What does that mean about a broader conflagration across the Middle East? And what would that do to risk assets as a result of that? Certainly, that's something we're going to touch on. In addition to those topics, we'll also go over how the market's been behaving the first couple of weeks of the year and how leadership may show signs of resilience or transition as we approach the first month or the back half of the first month of 2024. So let's go ahead and get started. The title of this week's presentation is, of course, the launching of airstrikes and what does that mean for stocks? And whenever we see a global conflict like this erupt, especially in an important area like the Middle East, where strategic resources such as crude oil and liquefied natural gas come from, we certainly have that predisposition to say, well, I must sell stuff in order to play defense or as my next move. And it's a little bit more nuanced than that. And so the three things we'll be going over this week are obviously the impact of geopolitics, some of the trouble that we're seeing at the top of the market. But again, that doesn't mean you go and sell everything. It's the areas at the very top of the market that largely were successful in 2023 that are showing some signs of cracking, while the average stock has actually been acting better. And that leads us into the second point there, which is where is the value in today's market? Certainly, if we look at one of our mistakes over the last couple of years, is that there probably was a lot of value in some of those FANG or Magnificent Seven stocks after they got obliterated in 22. Where do we see that value today? Making sure that we always resort back to that price first type of investment model. And then lastly, is that Bitcoin ETF a game changer? I'm going to address that verbally really quick there at the end of the presentation, but we're not very focused on that area of the market right now. So just as a quick reminder, that framework for 2024 is that we really do see the 7 largest stocks showing signs of fatigue. This was a slide we used last week, and we're using it again because the action that we've seen here over the last couple of days continues to indicate some exhaustion in those areas and other areas of the market starting to pick up. We certainly see the Fed shifting from attacking inflation to preventing inflation. And there's some nuances there. We do think that the Fed rate hike campaign has largely come to an end, but we're also not on the side of the boat of thinking the Fed's going to cut 6 or 7 times, because the Fed usually reserves rate cuts in response to something, the same way they increase interest rates in response to something. Inflation starts to ramp up, the Fed increased rates to respond to inflation. 2020 happened, Fed cut rates to 0, introduced QE again. Why? In response to the COVID shutdowns or recession and responding to recessions in the form of rate cuts. They tend not to be what we call proactive, right? Where they say, well, we think this is going to happen, therefore we do. They are a data-driven institution. And some of the drawbacks of data-driven can be that they are chasing a situation versus anticipating a situation. So that's what we see there in 2024. Growth expectations, we do think will rise as it relates to the economy. Lots of recessionistas out there that remain. We think they slowly get dragged at least back into the neutral boat. I think that leads to a steeper yield curve. That's great for cyclical assets, not as great for some of these secular growth stories that really shine during times of low growth. And then lastly, small cap stocks, value stocks, areas of the market that largely did not participate in 2023. We think there's a catch-up trade there with money coming out of the top of the market. Now, We see that weakness at the top. We want to show Apple and Tesla as two quick examples here. We can see Apple remains far off its peak of 200. We were at 185 here last Friday. And most importantly is the relative strength chart here at the bottom. So when we look at Apple relative to the S&P 500, Apple has actually, believe it or not generated outperformance versus the S&P 500 going all the way back to the beginning of 2022, and in fact has underperformed the S&P 500 since May of 2023. We look at relative strength as sort of that what we call a leading indicator, I guess you could say, or reading the tea leaves of what might be happening below the surface of a stock price to show what institutional money may or may not be doing that you can't quite see in the stock price itself. And many times you could have a stock hitting an all-time high, but where the RS or the relative strength has already started to sell off. And we see that dislocation, we try to understand, is that a temporary condition or ailment of a stock before it continues to power up to new highs? Or is that a leading indicator that a stock may start to gap down? And we think for Apple, we do expect this stock to continue to gap down. And we're not involved in the stock, but we do think Apple is an important risk barometer as it relates to the Magnificent Seven. Same deal with Tesla. A few more fundamental flaws. Obviously, car demand has come down for EVs in general. We've seen demand weakness for EVs in China, Europe, and the US. Hertz announcing that they will be cutting back or selling off 20,000 of their vehicles, EV vehicles, which are largely Tesla composed. So I think most importantly here is that just the EV segment has started to saturate out. Combine that with large institutional and retail ownership of the stock and an expensive valuation. That's areas where, again, we see that with Tesla in the fundamentals, but also in the charts. You can see here the RS really starting to weaken there as well relative to the S&P 500. And then, really the three areas of concern for the Magnificent Seven in general: a lack of catalysts, rich valuations, and they're very highly owned by both retail and institutional stock owners. We continue to see that rotation out of the top. So as those stocks have seen deterioration in their relative strength, we've seen relative strength improvement and strength out of the financials, out of some of the pockets of energy and consumer classes. Those areas have started to improve. Healthcare has been another sector that has been improving over the last 2 or 3 weeks. We don't have exposure to healthcare right now, but we are keeping an eye on it. It's a sector that really has done nothing since Hillary Clinton marked the top in it in 2016. And certainly it's a big component of the economy. So it's something that we're continuing to do our work on, sharpening our pencils on. We may introduce some exposure here in the next couple of months, but we're not there yet. But it does sort of reinforce this notion of a rotation out of the top, dominated by that Magnificent Seven, and into the rest of the market. And we see that here with financials relative to tech, both equal weight and in the small cap space, where financials continue to make new highs on an RS point of view. From a valuation standpoint, this is a chart that FactSet put out. I thought it perfectly encapsulates of what we've been trying to explain to investors over the last few months. We look at the 10-year PE average and where the PE is today. What we see is tech is very, very, very expensive, right? So trading almost close to 26 times as a sector. To put that into perspective, the S&P 500 is right around 18, 19 times, but by far and away the most expensive sector. The 10-year average for tech is in and around 18 to 19 times. So obviously a huge premium there, and you see that in the chart. Energy, on the other hand, is trading right around 10 times. And actually, for a lot of the stocks that we own, they're trading sub 10 times. We're talking 7, 8, 9 times earnings, in some cases 5 or 6 times earnings. So at a very deep discount to the 18 to 20 times average that this sector typically trades at on average. And we see the same thing with financials. Financials are kind of right on par with average. So here's one area where we think this chart doesn't do enough justice. Financials are trading right around 14 times. The stocks that we own, a little bit less than that, but it's also trading around 14 times the 10-year average. Now, what happened 10 years ago? We had the financial crisis, right? And so after you get a big crisis within a sector, those stocks tend to get impaired for about 7 or 10 years. So it's not surprising to us that the 10-year average for financials is rather subdued. So this is where we see another pocket of deep value within the market. We did get an inflation report this week. Remember, what's one thing that we've been saying over the last year? Inflation from 8% down to 4%. We think that's the easy part. The hard part is getting from 4% down to 2%. Why is that? Well, because you just have a lot of sectors that maybe didn't increase prices in the first leg that are now increasing prices to catch up relative to other areas of a sector. You're starting to see that a little bit. So a good example would be used car prices. Used car prices rose 45% early on. They're now negative. Well, what's offsetting that? Well, we're seeing auto insurance start to increase, right? And so that has offset the decline you've seen in the used car prices. If we look at the composition of where the rises in inflation have come from, housing and autos, right? And that's composed, of course, of auto insurance rates and mortgage rates, which have been led by the Fed. The good news is, obviously, if rates come down, housing should be a net detractor from inflation. Autos, kind of a wild card. We don't really have a view one way or another of where that will go. Again, it just kind of proves our point that we think inflation just remains stubborn in general, above target in that 3% range. And then if it is stubborn in 3%, I'm not sure it gives the Fed that runway to cut rates 6 or 7 times that a lot of people in the market are assuming. Because if you cut 6 or 7 times while inflation's at 3, you are increasing the risk that inflation swings back up toward 5, and then you have to really increase rates again, and that can hurt the market. We then, of course, have the Middle East, right? This week, what we saw, of course, is justified in our belief. Of course, you had a lot of container vessels that were getting struck by Houthi rebels out of Yemen that are based out of Yemen, certainly control a large part of that country. U.S. at some point had to take action there, and they did take action this week. Now, the risk is Houthi rebels have been striking ships in response to the Israeli conflict. U.S. has now struck an Iranian proxy in Yemen. So from a geopolitical standpoint, you likely have the Iranians to save face, say, well, we have to somehow respond back in kind through one of our proxies. Now, that could be through Hezbollah. That could be through the Houthis to try and strike a military ship. Remains to be seen, or through the Iraqi proxies, right? Hezbollah in Iraq, etc. How that all plays out, we don't know, but we do believe it increases the geopolitical risk premium in that area, and we think that benefits oil prices. And for those who know us, we love energy stocks because they're cheap, because we think supply-demand is that supply-demand balance is razor thin right now, and the lack of investment in the space over the last 10 years. The short-term spark may very well be what's happening in the Middle East right now. Again, a overall symptom of what we call sort of global powers competing against each other and competing for resources. And we think oil is right at the center of that. Again, we just wanted to show this chart again. Value relative to growth has already started to sell off in the small cap space for a long period of time. That has now started to play out in the larger cap. We are largely value oriented here at the start of the year, and we think that's a big, big theme for 2024. So areas to focus on as breadth broadens out: bank and insurance stocks, energy resource stocks, and of course, small caps over large caps, precipitated by what we continue to think is a steepening yield curve. And in summary, we really do think it makes sense to try and focus on some of those orphan sectors and stocks. We want to focus on those sectors with good fundamentals that got left out of the rally in 2023. Banks, energy, right at the center of that. Be careful with the big stocks at the very top of the market. They're crowded, they're expensive, great businesses, but everyone owns them. And then lastly, that Middle East situation does or is quietly getting worse. So that's what we got for you this week. 888-543-3776. Have a fantastic week, and please reach out to your advisor if you have any further questions. Thank you again, and have a great week.